Yesterday we asked whether the breather was a one-day pause or the start of something bigger. Today, the market answered. It was just a pause. The S&P 500 closed at a fresh all-time high, up 0.8% to 7,398. The Nasdaq jumped 1.7% to a record 26,247. That's the first close above 26,000 in history. The Dow, however, did something different. It gained just 12 points. Basically flat. We'll come back to that. Here's what drove the rally. The April jobs report came in dramatically stronger than expected. The economy added 115,000 jobs against expectations for 65,000. That's nearly double the consensus. Unemployment held at 4.3%. And this is now the second straight month of jobs reports beating estimates by a wide margin. The labor market is not cooling. It's accelerating. That's the headline. Now here's what's strange. While the jobs report was strong, the Iran situation actually got worse today. There were direct strikes between U.S. and Iranian forces in the Persian Gulf. The peace deal we said was nearing on Wednesday now looks less likely. Brent crude stabilized around $100 a barrel, meaning the geopolitical risk premium hasn't gone away. It's just no longer growing. But markets did not care. The jobs report won the day decisively. Good economic news beat bad geopolitical news, and the rally resumed. Sector action tells you exactly what kind of rally this is. Tech ripped. The S&P 500's technology sector gained over 3% in a single session. Nvidia rose almost 3%. Apple closed at another record. AMD finished a week in which it gained roughly 15%. Cisco added over 3%. Meanwhile, old economy names in the Dow took losses. IBM fell over 2%. McDonald's lost more than 1%. Visa dropped over 1%. That's why the Dow ended flat while the Nasdaq hit records. Same market, two completely different stories underneath. This is the AI concentration thesis playing out in real time. Tech is doing the work. Everything else is along for the ride. Now here's the warning signal worth knowing about today. It's not a new one. It's the warning signal we've been tracking all week, and today the case got stronger. Strong jobs plus sticky inflation plus the wage cost growth we covered yesterday equals one thing for the Federal Reserve. The hawks just got a major win. The dovish wing of the FOMC, which had argued for cuts based on labor market weakness, just lost their core argument. J.P. Morgan economists noted today that demand destruction is starting to show in energy markets due to high oil prices. Translation: inflation pressure is real and rising, the labor market is hot, and the Fed has cover to stay on hold or even consider hikes if the trend continues. The market hasn't priced this in yet. Watch what the FOMC says next. The S&P 500 and Nasdaq just posted their sixth straight winning week. That's the longest weekly streak since 2024 for both indexes. So what do you watch from here? 3 things. 1. Whether oil bounces hard over the weekend on Iran escalation. The peace trade is unwinding quietly. If Iran responds aggressively, Monday could look like last Monday. 2. Whether tech leadership keeps narrowing. Today's Dow versus Nasdaq divergence is one of the largest single-day splits in months. The narrower the leadership, the more fragile the broader market. And 3. Whether the Fed pivots from neutral to hawkish in the next round of speeches. Strong jobs alone won't do it. Strong jobs plus rising wages plus sticky inflation might. What started Monday as a war scare ended Friday with new records. That's not just a market that refuses to break. That's a market that has decided which stories it wants to hear. We cover the days the markets actually move, typically a few times a week, more when things get wild. Hit subscribe so you don't miss it. We'll see you next time.